Okay, dear students, it's time to discuss insurance. My least favorite part of the semester, but we don't call insurance the necessary evil for nothing because it is very important. So it is something we don't want to skim over, but we'll do our best to get through it as quickly as possible because it's not very exciting and it's kind of painful to, to be truthful, especially our next chapter on health insurance. But let's first start with home and automobile insurance. Because if you own a home, you need insurance. If you rent a home, you probably should have renter's insurance. We'll discuss that in a minute. And if you have a car, you must have automobile insurance. Well, not really, but yeah, you do. Okay, so let's get started on slide number 2. What is insurance? It is protection against possible financial loss. The insurance company, the insurer, is a risk sharing firm that assumes financial responsibility for losses from an insured risk. People, customers, purchase a policy and the insurance firm assumes the risk for a fee called the premium, which the insured policyholder pays periodically. Are insurance companies nonprofit organizations? No. Never forget this. In fact, some insurance companies, life insurance companies, are called the invisible bankers. And we all know that how do you know a bank is making money? Their doors are open. And the same thing is true normally for insurance companies. How do you know an insurance company is making money? Their doors are open, except in certain situations where things don't go as planned or as expected. But that's the insurance company's problem, not ours. Slide number 3. There are 3 terms that the insurance company wants you to know, and you look at these 3 terms and you think they all mean the same thing. Well, not to the insurance company, not to the agents and the people who work there, but, and I'm going to ask you on the exam, but you're going to forget because you're not in the business. Risk is the uncertainty or the lack of predictability, such as the loss that the person or property faces. Peril is the cause of the possible loss, such as a fire, windstorms, robbery, disease, or death. And hazard is something that increases the likelihood of the loss, such as driving drunk, smoking in bed, defective house wiring. So the risk is your home, the peril is a fire, and defective house wiring is a hazard that can increase the likelihood of a problem. So does that all make sense? I hope so. And if you don't remember it after the exam, oh well, you're not alone. So let's continue on slide number 4 and discuss another topic that you're going to forget, but maybe it'll jog your mind sometime in the future when you come across a discussion about insurance. And that's the difference between pure risk and speculative risk. And pure risk is what is insurable. That is the nature and the financial loss of the risk can be predicted. You have a house, it can burn down. You have a car, it can get in an accident. It can be personal, property, liability risk. These are risks that are legally in the United States allowed to be insured. There are speculative risks where there's a chance of a loss or a gain. These are legally uninsurable, such as starting a small business or gambling. Now, outside the United States, there are countries that allow for this type of insurance, but not in the United States. And the reason we discuss this, the reason we even bring it up, is to echo an idea that we talked about in the previous chapter, and that was the optional arm, right? The dangerous liar loans that were sold to mortgages to individuals who really had no business taking out a $500,000 loan. Where's the connection? Well, those loans were bundled into investments called bonds, which we'll get to in a few weeks, and sold all around the world. Now, individuals were allowed to buy insurance on those bonds, even though they didn't have any risk involved with the loan. They were essentially allowed to bet that these loans were going to go bad, even though they really did not own them. They were called we don't get into it, folks. It's really, really bizarre, and it should never have been allowed, but it was, because think about it. Can I insure my own house? Yes, because if my house burned down, I'm out. Can I insure my next door neighbor's house? No. If I did, what would stop me from I just accidentally knocked over the vat of kerosene and a match fell. You see? And this is what was going on during the great debacle, the great run-up in the 2000s of home ownership and the mortgages that should never have been allowed. So it's far worse than what we learned about in Chapter 7. And if you really, really do want to learn about it, you're going to have to do a lot of digging, because it's a pretty esoteric, exotic part of the investment world. And thankfully, they're not allowed anymore inside the United States. I'm sure some country will let you do it outside the United States, and I wish you a lot of luck, and I wish them a lot of luck too. So remember, pure risk is insurable, speculative risk is not, when there's a chance of a loss or a gain. Pure risk is, hey, there's going to be a loss, a car, a house, your health, dental, whatever. Risk management. Risk management is a long-range, organized, planned strategy to protect your assets and family. Risk avoidance, don't drive a car, or don't ride in a car. You don't have to worry about it unless you're walking. Risk reduction, yeah, you ride, but you wear a seatbelt. Risk assumption, okay, you drive, but you post a bond. You self-insure. Remember, I said very quickly that if you own a car, you really need insurance. Well, actually not. In the state of California, you can post a bond, which means you give the DMV $35,000, and that number hasn't changed since the 1950s. And if you're in an accident, then the money from the accident comes out of the bond, comes out of the money you gave the DMV. No, most people are not going to do that. And besides, $35,000 is not enough. What do people do? They drive, but they buy insurance. And what happens is, because there are millions of Californians and tens of millions of people around the country who drive and buy insurance, the insurance company can spread the risk around and take their cut. Most people use a combination of these strategies, often without planning or conscious forethought. And what we're going to find is that most people are underinsured or uninsured. Underinsured is typical. Or they're insured for the wrong things. Wait till we get to life insurance. So that's why we need to learn about it, to educate ourselves, to make sure we're not buying insurance that we don't need, and we're buying enough insurance that in case something does happen, we're covered, we're protected. What are some of the examples of the risks you face? Well, there's disability, which is the most widely neglected risk. It sounds like a test question. Yeah. Illness, that's health insurance. Death, that's life insurance. Wait a minute, are they going to bring you back to life? No. That's not what life insurance is all about. Property, which is what we're going to discuss in this chapter. Home, automobile, physical damage, loss of use. And then one risk that people just don't think about until something tragic happens. And that's personal liability insurance. You are legally responsible for another person's losses or injuries. And there's vicarious liability. That's if your son or daughter does something, you're the parent or the guardian. You're responsible for what they did. Oh boy. So negligence. Negligence is the failure to take ordinary and reasonable care. Failure, for example, you need to remove items from a frequently used staircase. What you want to do as an individual, especially if you're a homeowner, or even if you're not a homeowner, you want to beware the attractive nuisance. The biggest example of this are pools, right? Pools, and you see lots of public education campaigns, children drown without a sound. That's why you legally have to have it, cordoned off. Ladders. Don't lean a ladder against the house because the kids will start playing with it. Appliances outside. Yes, it used to be that refrigerators would latch and the child could not get out. Now they're a lot easier to open, but even then, it's not a good idea. If you have a refrigerator outside, tape it, or some people take the door off. And cars. Always lock your car. Yeah, locks are for the honest people. I know, to keep the honest people honest, because somebody's going to steal your car if they're going to steal your car. But more importantly, you don't want a child to get in the car and suffocate, or if it's a hot day. So always lock your car. Foreseeability is a critical factor in determining what constitutes an attractive nuisance. So in other words, could you have foreseen that there's a problem with this? And people don't think about ladders being a problem, but they can be. So let's continue. Planning an insurance program. This is yet another example of sagacious, you like that word? Pearls of financial planning wisdom from the insurance industry. Number 1, set your insurance goals and prioritize them. Number 2, develop a plan to reach your goals. And 3, put your plan into action. Number 4, review your results. To put your risk management plan to work, ask yourself what or who should be insured, for how much, from what kind of insurance, and from whom. Slide number 9. This is a more practical insurance planning program. Ask yourself, how much could we lose? How much could we lose? And if the answer is plenty, you need insurance. For home or auto, there's no question as to whether you need insurance, because you could lose plenty in both situations. Therefore, if you own a home, you need homeowners insurance. In fact, the mortgage company won't let you have the loan without insurance. If you let the insurance lapse, you signed, then that 100 pages of loan documents, that the insurance company could buy insurance on their own. They don't have to wait around for you. They'll just do, and of course they don't care what the price is. So keep your insurance in place on your home. If you own an automobile, you need automobile insurance, at least liability, which we're going to spend a lot of time on today. In fact, it is legally required. As we said, there's a way to self-insure, but nobody's going to do that. So let's discuss homeowners insurance. Homeowners insurance is coverage for a place of residence and its associated financial risks. The buildings, any other structures, plus trees, shrubs, and plants, additional living expenses if you can't live in the house, personal property that's in the house. No, it doesn't even have to be in the house. It can be anywhere. You have a very expensive computer. It doesn't matter where you are. If it's stolen, then you're covered. Now, we're going to talk about deductibles and limitations. So we're going to discuss floaters. What a silly name, floaters. But these are situations, we'll discuss this in more detail, where you have something that's very valuable. And the insurance company wants to know, okay, whoa, wait a minute, you have $10,000 worth of guns or camera equipment? Oh, no, you need a floater. You need additional insurance for that, or we'll cover it up to $2,000 or $2,500, but after that, forget it. $10,000 worth of jewelry? No, you have to have a floater. They want you to take photographs and make sure that you have the stuff if not, in case there's a fire or whatever. Now we're going to discuss earthquake insurance, and on the very last slide for today. It's important in California, but it really isn't. If you live in a floodplain, can you get insurance? Not easily. If you don't live in a floodplain, can you get flood insurance? Yeah, pretty easily. You see what you're up against with the insurance companies? And then medical payments. Now you have health insurance for that. But the one thing that people don't think about when they buy their homeowners insurance is the personal liability. Personal liability. You are being held personally liable for something you did. Now, this is not in your car. It's not if you're driving. That's a separate insurance policy. And we'll discuss personal liability because it turns out that this is actually very valuable. And it's one of the reasons why when we get the renter's insurance, that it really does make sense to have renter's insurance. If the house burns down, it's not your house. What do you care? But if you are in a situation where you are personally liable for something, the renter's insurance will take care of it. So what we want you to consider, and a good insurance agent will discuss this with you. If you go with your buyer, wherever you buy your homeowner's insurance or your automobile insurance, they're going to offer you what they call an umbrella policy. It's actually called a personal catastrophe policy, but nobody calls it that. It's mostly called an umbrella policy. And what it does is it supplements the personal liability coverage under your homeowner's policy or renter's policy and under your automobile policy. And typically it starts at $1 million. You can see them go up to $3 million. I've never seen more than $3 million, but $1 million that's a whole lot of personal liability protection. So discuss that with your insurance agent because they are worthwhile, as we're going to see on our, not this slide, the next slide. Okay, I know that's looks like a pickaxe, my apology, but that's supposed to be an umbrella. And what we get with homeowners and and renters insurance is personal liability, typically $300,000, which is, it's a lot of money. Not always. And then we're going to fill this out in our next presentation when we get to automobile liability. So once these limits have been breached, once the personal liability from the homeowners and the renters insurance or the automobile liability for an accident that you were at fault at, those limits are exceeded, the umbrella policy will kick in. Does that make sense? Because many people think they're fully covered when they drive a car. There's no such thing as full coverage, as we'll see in our next presentation. Once you've gone over these limits, and again, we'll discuss this in the next presentation, don't worry about it, then the umbrella policy kicks in. So think about it, because what happens? Here's a personal liability example. I know it's going to sound kind of gruesome, but hey, this can happen. You're playing baseball, everybody's having a good time, and you accidentally swing a bat into somebody's head, a friend of yours. He now requires 24-hour skilled nursing care, and it's $95,000 per year in perpetuity. So your homeowner's personal liability limit is $300,000, so they pay the first $300,000, and then they sit on their hands and say, that's it. That's what we contracted with. That's when the umbrella policy kicks in and will begin to pay once the $300,000 limit is reached. Given the cost of health care, next chapter, personal liability awards can be enormous. So your homeowner's insurance will have typically $300,000. Your renter's insurance usually will have $200,000-$300,000. Think about a personal catastrophe policy, an umbrella policy, and to cover if it's not going to happen, folks. Let's just think positively, but it can, and that's why it's good to have an umbrella policy. Okay, let's discuss renter's insurance very quickly. It's the same idea, except there's no building that they have to worry about. So it's going to be a lot cheaper. They used to be $100. I've heard they're a little over, a little $200 now. I don't know. I haven't bought it in decades, so I don't know. But I thought it was a lot less. I thought 40% of renters have a renter's insurance. I'm surprised it's that high, because most people who rent just don't even think about the personal liability. They may have a few things that they worry about. You have a computer, maybe a nice stereo, whatever. If it gets stolen, okay, it's not the end of the world. If the house burns down, it ain't my house. But again, think about the personal liability that you could incur just because you're alive. And again, it doesn't happen to happen in the house or in the apartment you're renting. It can be anywhere. Now, there are many different policy forms, and you would learn all about these in our insurance classes, which we actually have. And there's a future for you in the industry, folks. Believe it or not, the industry is huge. The insurance industry is huge, and everybody needs insurance. That's one of the cool things about when you become an insurance agent. It might be difficult to get people to think about putting money away in a Roth IRA or whatever as a broker or as a financial representative, but everybody needs insurance. So we talk about that in the financial services program that we have. The one that you mostly will get with a home is the HO5. The comprehensive form. A condo has a HO6, and then there's the renter's form. In addition, many homeowner policies cover such items as credit card fraud. People don't think about that. Or check forgery, temporary repairs, and fire department charges in areas that have a fee if they have to come out and put out the fire. So it's not exciting insurance, folks. I'll be truthful. Remember, I'm an insurance agent. I've sold 2 policies. One was rejected. And I just thought, I don't have time for this. I just didn't. I don't have time for it. My teaching and the broker takes enough, and that's all I need. If I ever have to, though, if ever everything push comes to shove and I can't teach anymore, and the brokerage firm, whatever, I will go start selling insurance because, as I said, everybody needs it. Okay, how much coverage do you need? Now, this is something that when I first learned about it, before I was an insurance agent, I was not happy about it. The insurance companies want your house to be fully covered, all right? There's typically a co-insurance clause. They want you to insure your home for what it would cost to replace the home if it were burned down. So you might say, well, the house is, it could sell for $700,000. Why am I only insuring it for $350,000? Because that's how much it's going to cost to rebuild the darn thing. And they have their formulas that they use. What is the likely worst case loss? Plus, make sure you have the umbrella policy. Discuss with your insurance agent if you have jewelry, guns, cameras, serious stereo equipment for the floater. And where does the term come from anyway? Well, insurance actually started out with ships. Yeah, the ships in the age of exploration was about were insured, and there were floaters for additional items on the ship. So that's where the name came from. There's a bit of trivia for you. Now, you want to determine the value of the contents of your home. There are many different flavors of these 2, but there are basically 2 different types of coverage for items: actual cash value and replacement cost. Now, we're going to do a couple of problems with these, but all you have to remember is that you want replacement cost. And there might be a couple different flavors of it, but just tell your insurance agent, I want replacement cost. It doesn't cost that much more. A few bucks more. What happens? If you have actual cash value, they depreciate. Now, if you haven't taken in accounting, don't worry, you don't need to learn it. We're going to just do a very simple depreciation calculation. It's not hard to do. And if you have taken accounting, don't worry, it's not accounting. No trial balances, no journal entries, just don't drop the class. So you have to depreciate the value of the item. If it's 5 years old, well, what is it worth now? The other one, which is what you want, is the replacement cost. What would it cost to replace it? And that's the one you want. Just remember that. I want replacement cost. And then the agent might show you a couple of different options for replacement, but I want my stuff replaced if there's a fire or whatever. The co-insurance clause is that nasty little thing we talked about just a few moments ago. If you do not have your home fully covered for what it would cost to replace it, not for what it paid for, not what you paid for, but what it would cost to replace it, then you might get dinged. The co-insurance clause requires the homeowner to pay for parts of the losses if the property is not insured for typically 80% of its replacement value. So let's use a very simple number, $200,000. Not the price of the house, but what it would cost to fix it, to build it from scratch. So you had a $40,000 loss. You might have only had $150,000 worth of coverage. So what the insurance company says, okay, wait a minute, $200,000 is what it's going to cost to rebuild it. Remember, you only had a $40,000 loss, but it would cost $200,000 to rebuild it. 80% of that is $160,000. So you are out of compliance. You are underinsured. So now the insurance company says, okay, we'll pay $40,000 loss times $150,000 what you had it insured for, divided by what should have been insured for, $200,000. That's 75%. So they're only going to pay $30,000. You've got to pay the extra $10,000. And I learned this many years ago, before I got my insurance license. And I'm talking to the guy on the phone about insurance, and he's telling me about the co-insurance. I was shopping around. And I said, but that's ridiculous. I mean, if our house burned down, we wouldn't build the same house. It's kind of big for us. We would build something smaller. And the guy acted as if I just said we would eat babies or something. I mean, he just went, I've been in this business 27 years. I ain't never seen anybody build something smaller. And I thought, right, this is America, right? we want something always bigger. So, okay, I got it. All right, sorry, Mr. Insurance Agent. Sorry, insurance companies. I understand why you have this nasty little insurance clause, co-insurance clause. So make sure a good insurance agent every few years is going to say, hey, you know what? We need to up your coverage on your house because it's now going to cost $300,000 to replace, not $250,000 to replace. Okay. What are some of the factors that affect home insurance costs? Well, how close is the fire department? That was one of the first things they asked me when I bought the house. The insurance agent said, well, where's the fire department? I said, well, don't you know? I mean, I get about a half a mile away. What is the age of the structure? What is the amount of coverage and your deductibles, which we'll discuss in just a moment? Do you have an alarm system, a smoke detector? Do you insure your car with the same company? You should get a discount. Compare the costs and coverages because the numbers are all over the map. I will never understand how the insurance companies charge. They just throw numbers up and down. And sometimes you get a really good price and sometimes you get a horrible price, and all you got to do is call the next day and it's different. Check consumer reports. We talked about them before. And they look at the claims history. They look and see if you've had any claims. Interesting. In other words, you use the insurance, you may lose the insurance. And of course, the insurance regulators are not happy about this, but the insurance companies use it as one of their constraints, one of their criteria for when they charge you. Okay, well, if it's not illegal, then they can do it, and they will. I'm not sure if they can still do this anymore, but they were using your credit scores. They were looking at your credit scores, because they found that the credit score was an indicator, a bad credit score was an indicator of somebody who has more claims. They don't ask why. They don't care why. Insurance companies are very good with numbers, very good with statistics. and they just want to make money. Slide number 19. Here's an example. Your home insurance policy, and by the way, there's a handout that comes with Chapter 8, and it's got some home, which we're going to do now, and it's got some automobile exercises, which are going to be on the exam and going to be on the worksheet and the assignment. So please do these. They're not that hard once you've done them a couple times. And of course, contact me if you have any questions. Your home insurance policy has a $500 deductible. Your beautiful towering eucalyptus tree drops a huge branch onto your roof and causes $4,500 worth of damage. What amount, if any, would be covered by your insurance? So in the face-to-face class, we have these ABCD cards, and people they put up the number they think, $500, $4,000, $4,500. No, they won't pay anything. Well, actually, they will not pay the deductible. The deductible is the part that you must pay first. So they say, okay, the first $500, it's on you. So if somebody throws a baseball through your window, they don't want you to call them up and say, I want this window replaced. It's only going to cost $120, whatever. You deal with it. And the higher the deductible, $1,000, $2,000, the lower your premium. So the insurance company will not pay the first $500. But then they will pay all the way up to the limit on the policy, which for a house is going to be several $100,000. So they're going to pay $4,000. You must pay the deductible before the insurance company will pay anything towards the claim. Make sure you understand that. If not, contact me, because that's a very important aspect of insurance. And some people get confused about the deductible. No, you don't get paid the deductible. You pay the deductible. And then the insurance kicks in. Your homeowner's policy has replacement coverage for personal property. Okay, now here are the maximums for certain items. Guns and jewelry have a $1,000 maximum, and we're going to ignore any deductible, okay? They say that guns and jewelry have a $1,000 maximum. So let's say the deductible is $0 just to make the calculations easier. If it's not specifically excluded in the policy, then it is automatically included. So a $2,000 gun, a $3,000 bracelet, and a $2,000 computer was stolen from your home. What amount, if any, would be covered by your insurance? Okay, now wait a minute. Let's think. Okay, wait a minute. No deductible, so don't have to worry about the deductible. Guns and jewelry have a $1,000 maximum. So it's a $2,000 gun. They're only going to pay $1,000. It's a $3,000 bracelet. They're only going to pay $1,000. So that's $2,000. Did it say anything about computer equipment? No, that was not specifically excluded, so it is automatically included. So $1,000 for the gun, $1,000 for the bracelet. I said it correctly that time. And $2,000 for the computer. It would be A. If an item is not specifically excluded or limited, then it is fully covered. So go through this worksheet. There's an answer key, and there's of course we're going through it now, and do these because they're pretty straightforward. Now here's the trickiest one. And we don't want actual cash value coverage anyway, so if you don't get it right, don't feel badly. But you should get it right for the exam and for the worksheet and for the assignment. The homeowner policy, unfortunately, has an actual cash value coverage. Ignoring the deductible, so let's get the deductible out of the way, no $0 deductible. If a $2,000 computer with a 4-year lifespan were stolen from your home after 3 years, what amount, if any, would be covered by your insurance? So if you had replacement coverage and it was not specifically excluded and we didn't have to worry about the deductible, they'd pay the whole $200,000. But they say, no. We're going to depreciate that, which is a fancy word for it goes from $4,000 down to $0. No, I'm sorry, $2,000 down to $0. So if a 4-year lifespan, 4 divided by 2,000 is $500. Every year it's going to go down $500. So after 3 years, right, it's going to be 500, then 1,000 and 1,500. So what they're going to pay is $500. Yeah. So do you see why you do not want actual cash value? You want the darn thing replaced. Hey, I was using it. I have to go out and buy another one at $2,000. So no, thank you. I want you to cover it for the full replacement value. Cool. Okay, so do those over a few times, and then there's the assignment, and then slide number 22, availability. For decades, availability was not an issue. Every homeowner could easily find insurance. Recently, insurers have become very picky about who they will insure. They are not only using claims history, they're now using credit reports. Now, I put a question mark because I told myself to go look this up because I thought California was going to make that illegal. But I don't think they did. I think they were talking about it, but I don't think they did. But the insurance company said, look, hey, if it costs us money, we should know about this. If we know that these people have a bad credit history and we know that people with bad credit histories have more claims, we should be able to charge accordingly because, we're not in business to lose money. So, so I should go check. You do it. You check and tell me. Any data from other homes? They're going to look at other homes in the area. And they may ask you to effect some expensive repairs, especially if you have an older roof that could catch fire easily, if you live in an area where there's sparks flying. Yeah, I remember many years ago we had this beautiful vine. It was a passion flower, and it gave fruit. The insurance company says, cut it down. So what do you mean, cut it down? They said it's a fire hazard. See, there's a hazard. And then I read about it and I thought, yeah, they're right. These things catch fire. So we cut it down. Slide 23. What about earthquake insurance? Now, in California, any insurance company that sells homeowners insurance must also offer you earthquake coverage. Here's the problem. It's not that expensive, but it's not that worth much. There's a minimum 10% deductible, even upwards of 15 and 25%. Now, what does that mean? So if you had a house that would cost $300,000 to replace, you're going to pay the first 10% or $30,000. 15% would be $60,000. 25% would be, I'm sorry. 20% would be $60,000 and 25% would be $75,000. In other words, the deductible is outrageous. The amount of damage to a $300,000 home in an earthquake is usually much less than $30,000. But of course, it depends on when your house was built, what type of house you own, if is it wood frame, is it brick, is it older versus newer. And so if you have a newer house that's wood frame, it's not likely that you're going to see serious damages to the foundation, to the house itself. But if it does occur, and there are thousands of houses that need to be completely gutted or they get to put them back up on the foundation and fix the foundation wall, the insurance companies are just going to throw up their hands and say, we're bankrupt. So I don't really trust it myself. I think the whole thing is kind of silly to think we could rebuild after the big one hits. Well, we don't know it's going to hit 500 years from now, 1,000 years from now. We know it's going to hit. And when it does, it's going to be ugly. So for what it's worth, your boy here doesn't own it. Instead, use the money you would spend on the earthquake insurance to earthquake-proof your home. And there is a ton of money and resources that the state of California has created to help people understand what they can do to in the event of a major earthquake. And nobody reads this stuff. There are just so many cool things you can do. For example, right now, today, put some old tennis shoes underneath your bed. Huh? What? In an earthquake, in the emergency rooms, one of the biggest reasons people show up at the emergency room in an earthquake are foot lacerations. Yeah, in the middle of the night, there's an earthquake. People jump up, run to see if the kids are okay or whatever. And there's glass, broken glass everywhere. The dishes have fallen off or whatever, lamps or something like that. And it's dark and they're bumping around in the dark and they cut their foot wide open. So you see, get a pair of old tennies, put them under the bed, and as you're groggily waking up, put them on your feet. Another thing, there are these wonderful little things you can do to tie down lamps and bookshelves and other things that are going to be flying around if there's a major earthquake. And check out, just type in California earthquake preparedness or whatever. You'd be surprised at how much the state of California has spent and how little people actually use it. We're humans. We don't want to think about it. We just want to go about our daily life. And if it happens, we'll deal with it. Right. Okay, dear students, that was our introduction to investments, to insurance, and our discussion of homeowners insurance, renters insurance, and the like. In our second presentation of Chapter 8, we'll discuss automobile insurance. And you, dear students, are going to see that this second presentation alone is worth the price of admission for this class. Because there are tons of people driving around thinking that they're fully covered and don't have anything to worry about. And ain't nothing close to the truth. That ain't nothing close to what the reality is. So see you on our next presentation. Thank you so much for being in our class. We are so, so proud of you.